Have you ever stopped to think about what money really is? We see it every day, we use it to buy things, we work hard to earn it. It might be a crisp banknote, a shiny coin, or just a number on a screen. But if you really dig deep, what gives this piece of paper or this digital number its value? The answer might surprise you. It's not gold, it's not the government, it's something much more fundamental, much more human. It's trust. Today, we're going to unravel the invisible threads of trust that hold our entire global financial system together. Let's travel back in time for a moment. Before money existed, people used a system called barter. If you were a farmer with a surplus of wheat and you needed a new pair of shoes, you had to find a shoemaker who just so happened to need wheat. It was inefficient and complicated. Imagine trying to trade a cow for a loaf of bread. It just doesn't work. So societies developed what's called commodity money. These were items that had their own intrinsic value, like salt, shells, or precious metals like gold and silver. This was a step up, but it still had problems. Carrying around bags of gold isn't exactly practical or safe. This is where the concept of money began to evolve. Governments and banks started issuing paper notes that represented a certain amount of gold or silver held in a vault. This was called the gold standard. You could, in theory, take your paper money to the bank and exchange it for a lump of gold. This system was based on the trust that the gold was actually there. People trusted the paper because they believed it was backed by something tangible and valuable. It was a promise, a claim check for real gold. But here's where it gets really interesting. Most countries, including the United States, abandoned the gold standard decades ago. The dollar bill in your wallet is no longer a claim check for gold. So what is it? It's what economists call fiat money. The word fiat comes from Latin, and it means let it be done, or it shall be. Fiat money has value simply because a government declares that it has value, and we, the people, collectively agree to accept it as a medium of exchange. Think about that for a second. The only thing backing the money we use today is a shared belief system. I accept your dollars for my goods and services because I trust that someone else will accept those same dollars from me. It's a massive global network of mutual trust. If we all woke up tomorrow and decided that these colorful pieces of paper were worthless, they would be. The entire system is built on this collective confidence. It's a social contract. This web of trust extends far beyond just physical cash. When you deposit your money in a bank, you're not just storing it in a digital vault. The bank doesn't keep all that money sitting there. It lends most of it out to other people and businesses who need loans for mortgages, car payments, or starting a new company. You trust that when you need your money, the bank will be able to give it back to you. This is known as fractional reserve banking. The bank only keeps a small fraction of deposits on hand. This might sound a bit scary, but it's the engine of our economy. It allows capital to flow to where it's needed most, fueling growth and innovation. But again, it all hinges on trust. If everyone suddenly lost faith in the banking system and tried to withdraw their money at the same time, a phenomenon known as a bank run the system would collapse. The bank simply wouldn't have enough physical cash to pay everyone. This is why governments create institutions like the FDIC in the US, which insures your deposits up to a certain amount. This insurance is a promise from the government, designed to bolster your trust in the banks and prevent widespread panic. It's trust, backed by another layer of trust. Let's look at the stock market. When you buy a share of a company, you're not buying a physical piece of that company. You're buying a digital certificate that represents ownership. You are trusting that the company's leadership will make good decisions, that their financial reports are accurate, and that the company will grow and become more valuable in the future. You trust the stock exchange to execute your trade fairly. You trust the regulatory bodies to police the market and prevent fraud. It's a complex ecosystem of interlocking trust relationships. When that trust is broken, say, through a major accounting scandal, you see the devastating consequences. Stock prices plummet, investors lose their savings, and confidence in the entire market can be shaken. Even modern innovations like cryptocurrency are, at their core, about trust. Bitcoin, for example, isn't backed by any government or central bank. Its value comes from a network of users who trust its underlying technology, the blockchain. They trust the decentralized, cryptographic system to be secure, to accurately record transactions, and to be immune to censorship or control by any single entity. The entire multi-trillion-dollar crypto market is a fascinating experiment in creating a new form of trust in code and algorithms, rather than in traditional institutions. So what happens when this fundamental trust breaks down? We get a financial crisis. The 2008 global financial crisis is a perfect example. It started with a breakdown of trust in the housing market. Banks were giving out risky mortgages, bundling them into complex financial products, and selling them to investors. Credit rating agencies who were trusted to assess the risk of these products gave them top ratings. Everyone trusted that housing prices would keep going up forever. When the bubble burst and people started defaulting on their loans, the entire house of cards came tumbling down. The trust between banks evaporated. They stopped lending to each other because no one knew who was holding the toxic assets. The credit markets froze, and the global economy was pushed to the brink of collapse. The crisis wasn't just about bad investments. It was a catastrophic failure of trust at every level. Recovering from such a crisis is a slow and painful process. It's not just about injecting money into the system. It's about rebuilding that lost confidence. Governments and central banks have to take extraordinary measures to signal that they are a credible backstop, to restore faith that the system is sound. It's a delicate psychological game. This concept of trust as the foundation of finance isn't just an abstract theory. It affects you personally every single day. When you use your credit card, you trust the merchant to charge you the correct amount and the credit card company to process the payment securely. When you invest for retirement, you trust your financial advisor to act in your best interest. When you pay your taxes, you trust the government to use that money to provide public services. Our economic world is not a machine of cold, hard numbers. It is a deeply human system animated by our beliefs, our expectations, and our faith in one another. Money is not just a tool for transaction. It is a symbol of our collective agreement, a physical manifestation of our mutual trust. It's the invisible glue that allows millions of strangers to cooperate and create the complex, interconnected global economy we live in today. So the next time you hold a dollar bill or tap your card to pay, take a moment to appreciate the incredible, invisible network you're a part of. It's not just about the money. It's about the trust that makes it all possible. And that's a concept that's truly priceless. Thanks for watching. If you found this exploration of trust and money fascinating, make sure to hit that like button and subscribe for more deep dives into how our world really works. See you in the next video.